Hi guys, good afternoon and welcome to this Mutual Fund Corner special. I'm Pavitra Parekh and today we're going to discuss everything that we've seen going down with the debt funds. Of course, we first had that amendment that came through to the tax rules. So a big change over there. The indexation benefit was taken away. So, this category has been in focus anyway. We also got the mutual fund numbers for the month of March just last week. So to discuss how the flows have really looked, the different categories and what we can expect from here on, we have Rahul Jain joining us. He's President and Head at Nuvama Wealth. So Rahul, as always, it's a pleasure to have you on and thank you very much for taking out the time today. My first question to you is on exactly that, on the flows that we've seen into debt funds. Of course, we had that entire tax change come through. So take us through how you're reading the flows. It seems like a lot of the money has moved from the short-term categories to the longer duration funds. But of course, this was also the year-end period, right?
Yeah. So indeed, I think the flows were huge, at least in the last week. Post the notification came on the debt mutual fund side, and the lot of money went to the longer duration debt funds. And I think it seems to be obvious also because investors were always looking of blocking at higher yields, and also added by the whole tax efficiency which was there, which was bound to get over by 31st March. And that's why there was a lot of keen interest which came in from a lot of investors. And that's why you saw record inflows happening in that last week of the March on the long duration fund. And obviously, some money has also moved out from short term because people who would have realized that they have excess liquidity right now with them, they have moved into longer duration fund because it seems to be opportunistic one. Apart from that, I think in the end March, always the shorter duration funds get outflow because of the advanced tax payments. But on the long duration time, I think the last week was huge inflows.
Okay, so that is on the inflows that we've seen in March. Rahul, the question now is, how do you think it's likely to be from here on, right? Because, of course, we saw this money rush in the last week, sort of just trying to grab that indexation benefit. But do you think from here on, this category will suffer somewhat of, in terms of what we can see in flows? Will we see lower flows?
So, Pavitra, if you break it up in two parts, so the short-term duration funds, effectively, they are status quo. So I personally think that there should be no change happening there. Right? Liquid funds, ultra short-term funds, all should remain what they were doing earlier as well. I think the longer duration funds, which had the tax efficiency, uh, will now have a level playing field with other traditional uh, investment ideas like NCDs, uh, FDs, bonds, or the longer duration funds. So all will have a same level playing field. Our take is that the investor money will flow in wherever you get a better tax adjusted return with liquidity. And wherever you find that better, I think the money will keep flowing there. That is what our take is on how the future will pan out for debt mutual fund on the longer duration point of view.
Okay, and there's also another big thing which happened, right, since the last time that we've spoken, which is that the RBI paused on rates. That is another thing that would impact the debt funds. So in this scenario, think of someone who's getting into this space. Would you say that this is a good time to be looking at debt? I mean, leave aside the debt equity allocation. That, of course, we always advise people to do that. But in general, if someone has excess liquidity, do you think that this is perhaps a better time to look at debt than equity, considering what we're seeing with the markets anyway?
So if you look at RBI's paused its rate hike in the last MPC, and
Yeah.
we feel that it will have a neutral stance going forward before it start cutting rates also, because in the last March inflation came at 5.66, which was under the control of the definition of RBI. For anyone who's looking for debt investment who has excess money, I think debt looks right now very attractive because uh, it's a good time to lock in interest rate from long-term investment point of view. And I think using either the debt mutual fund, NCDs, bonds, and FDs might be a good way of parking their money right now, because the interest is what you're getting right now. The chances is that 6 months down the line or 12 months down the line, your ability to lock in such rates would not be there. So to answer you, I think it's a good time to add to the debt portfolio, whether it should be in the form of debt funds, FDs, bonds, NCDs. I think that an individual should assess on the basis of liquidity his tax adjusted returns, and that is how you should evaluate. But it's a good time to invest in debt.
All right, good time to invest in debt. Then let's talk about some of the categories of within debt funds that could see good amount of flows. Rahul, what is your take on target maturity funds? This is a space that has become so hot. It's seeing a lot of traction. Is this something that you like and advise as well?
So, target maturity funds, Pavitra, were becoming very popular because they were giving good yields around 6.5 to 7 in a 5 to 7 year duration, and also it had tax efficiency built along with it. But now, since that tax efficiency has gone away, I think it will now compete with other traditional products in the same asset class like FDs, bonds, NCDs, etc. And what we see is that the yields what the other uh, uh, alternatives like FDs, bonds would be higher than target maturity funds. So our way of looking at it is that it might lose its sheen over a period of time because you will have better alternatives giving better higher yields. And in that case, the investor flow would obviously move to, as I would have said earlier, said better tax adjusted returns product. Sorry, risk adjusted return products.
Okay, got that. That is your call on target maturity funds. But Rahul, tell us for someone who is perhaps a new investor, doesn't know too much about the market, but wants some amount of exposure to debt. Is there some, or are there a couple of categories that you think you would recommend, or just are well suited for most people?
So if someone wants to dabble in debt mutual fund as an experiment, we will advise them PSU or banking bond fund, which is largely 80% is into very high quality assets, largely AAA rated bonds, and it is considered to be very stable and secure. So it's a good start from debt fund instrument point of view. Also, people can look at AAA rated entities to start their debt investment. So that is how someone should think about starting on the debt mutual funds side or debt side if it's starting from the first time.
Okay, and you mentioned fixed deposits just a short while ago as well, and ever since that entire tax rule change came, there was this immediate sort of call coming in. Should we just move to fixed deposits? Should we just get out of debt funds? What is your take on that? I think I know your take, but I think you say it.
No, so I again say that it depends on individual tax risk adjusted returns plus liquidity, and then you should take a call. Is a fixed deposit a good alternative? Answer is yes, because it comes with a lot of security. It comes with easy liquidity also, and now the yields are also fairly attractive. So I think it has to be a combination of what your risk adjusted return you're thinking in your mind, and what type of liquidity you want to look at, and what type of duration you want to invest, and then take a call on the basis of that. But now, since all the uh, alternatives are on the same level playing field, I would say that go with which gives you the highest yield with the risk adjusted.
Okay, just one final question, Rahul. I know there's no one size fits all approach here, but say you want to sort of give some kind of debt to equity split that an investor should have. Do you think you could break it down for us just in terms of, say, if someone has a low risk appetite, someone who has a moderate risk appetite, and then aggressive?
So, to make life more simpler, Pavitra, I think a person should use a simple formula: is 100 minus his age should be his equity portfolio. So suppose someone is at 30 age, the 100 minus 30, 70 can be equity portfolio, 5% can be gold as part of asset allocation, and rest can be debt, 25%. Now the individual can go into short-term, long-term, mid-term duration sort of debt alternatives, whichever is more suited, which helps them to achieve his financial goals. And that is how we should look at about it. If you want to again do more conversation on this, is that if someone is higher risk, then rather than doing 75% equity, he can do 80% equity, less debt. And someone who's lower risk averse, he can do 70, 65% equity and 25% debt. So that is the max change here we can do here and there. But largely 100 minus 8 should be equity portfolio, and then balance 5% gold and rest should be debt.
Okay, that makes it quite simple for anyone to be able to calculate. So Rahul, thanks a lot for taking us through that short but very informative discussion on, how the debt flows have been, and also some categories that you can look at if you do want some exposure to this within your portfolio. We're going to wind down on that note, but
Thanks,
Rahul, as
Pavitra, for
always,
inviting me to the show.
Thank you for joining us. And with that, it's a wrap on this edition of Mutual Fund Corner.